In the last 2 months, a lot of my friends and clients have been telling me, Bernard, the economy is very bad. We are in a recession. Property prices are going to crash coming Q3 and Q4. However, in August, not only did the HDB prices and private property prices not crash, but they went up instead. And this has caused a lot of confusion with a lot of people. So why did this happen? And will property prices crash as what they have predicted? We will address these in the video today. Here is a chart taken from UOB Global Economics and Markets Research, showing the Singapore GDP in red, property price index in dark blue, and the amount of liquid assets Singaporeans have in light blue. Since we generally peg the economy's performance to the property market, it is important to see these three charts together. Because if you were to assume that a shrinking GDP translates to a crashing property market, without looking closely at how the different charts really relate to each other, you may lose that 500,000 profit if you enter the market later than those who bought before property prices shoot up. As we look at the last 3 recessions Singapore faced, you will notice that prior to each property market crash during these recessions, a few years before the crash, the rate of property prices increased at a faster rate than the GDP, creating a property bubble. So when the recession happened, property prices crashed and dropped back to levels at or close to the Singapore GDP graph, as you can see from the chart. However, what happened prior to this current recession is that not only did the property price index not increase faster than the GDP, it grew at the same rate as the economy from 2010 to 2014 and stagnated from then onwards, even though the economy continued to grow. Therefore, the property price index has actually crashed before the current crisis. Therefore, based on historical trends, we should not be seeing a sharp decline in property prices unless the GDP graph declines below the property price index, like how it was in the last 3 recessions. And for that to happen, the GDP need to drop by an estimated 23%. The other comparison we should look at is the ability of property owners to pay their mortgages. So as we look at the graph of liquid assets Singaporeans have on hand compared to property prices, in the last 3 property crashes, the rate of increase in the property price grew faster than money on hand prior to the crash. However, since 2011, the money on hand by Singaporeans grew faster than the property prices, which means Singaporeans in general have more money today compared to the last 3 recessions. This is one reason why property prices today has remained stable, as property owners have the means to continue funding their property and not sell their property to cut loss. Therefore, with the already depressed property prices, it is unlikely they will fall any further, unless the money on hand Singaporeans have and the economy drop by a very big amount. Furthermore, with the improving manufacturers' output recently, we are probably seeing a recovery in the economy already. But does this mean that this is the right time to buy a property? If you are curious to find out more, drop me a private message.